Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. So today we are doing a really critical deep dive. We're looking at the global economy through, well, two massive trends that on the surface look totally disconnected.
They really do.
Yeah, but they're actually, I think, joined at the hip by this one single thread. Just profound, deep uncertainty. On one hand, we're going to dissect the anxious U.S. labor market. We're going to look past those, kind of mild-looking jobs data reports and really try to understand why the American worker just feels absolutely terrible right now.
The psychological part of it.
Exactly. And then, on the other hand, we're going to pivot to this huge macro story, the historic surge in gold prices. I mean, it just blew past every record we've ever seen, and it's being fueled almost entirely by sovereign entities, global central banks.
It is absolutely essential that we talk about these two things together. You really can't understand one without the other. They represent, the internal stress and the external hedge of the entire modern economy.
I like that. Internal stress, external hedge.
Exactly. So part one is all about Main Street's health. The job engine is slowing down. There are these huge structural shifts happening in different sectors because of automation, and that's creating this rising anxiety that, it dictates how people spend their money.
Right.
Then part two is the macro uncertainty piece. Why are the big global players, the central banks, prepping for monetary instability and geopolitical risk by moving actual mountains of physical gold?
So our goal here is to get way beyond the daily headlines.
Way beyond. We need to find the structural why behind these, frankly, staggering numbers. What are these forces really telling us about, say, the next 3 to 5 years?
I love that framing. It's the story of the shrinking wallet meeting the fear of, currency debasement. Let's dive straight into part one and unpack this widespread labor anxiety. The data we've looked at, it paints this picture not of a collapse, but of deep caution.
Yeah.
It feels like the entire U.S. job market is just stuck in neutral, just rolling very, very slowly.
Stuck in neutral is, I think, the perfect way to describe it. What the data confirms is that the U.S. labor market is slowing down, and pretty significantly. This whole period, it's really characterized by two things. You've got extreme caution from employers.
Right.
And then rising vulnerability among the employees themselves.
Yeah.
We aren't in, a mass layoff cycle like we saw in 2008.
No, not yet, anyway.
Not yet. But we are certainly in a really painful stagnation phase.
Okay, so let's pull up the three key data points that really confirm this slowdown, because they all tell, slightly different parts of the same story. First, we had the non-farm payrolls growth for September 2025. It came in at a pretty meager 119,000 jobs.
Which is not great.
Not great at all. I mean, to put that into perspective for everyone, the Federal Reserve generally views anything consistently below about 150,000 jobs a month as, well, not enough to even absorb population growth. It means the market is already cooling.
Exactly. And when you look at the monthly job gains going back to April, I mean, the economy is barely staying in positive territory. It's crawling.
It's just crawling along.
And that has an immediate impact on the unemployment rate. The official rate, it rose to 4.4%. That's flirting with a 4-year high. Now, historically, 4.4% isn't, a catastrophe.
Yeah, it's not 10%.
It's not 10%, but it's a substantial step up from the tightness we saw during the recovery when the rate was, well below 4%.
Yeah.
And the Chicago Fed's own November estimates, they confirmed this level, 4.4%. It just shows that labor slack is building up.
Okay, now here's where the numbers get a little more, unsettling. And it's why you have to look at more than just that official Bureau of Labor Statistics, the BLS report. We also have the ADP Private Employment Report. That came out in early December. And that report indicated that private jobs decreased by 32,000 in November. So a swing back into negative territory after, a brief positive moment. Why should we care about that ADP number when we already have the official NFT data?
That is such a critical distinction. The ADP report, it's often seen as a really useful proxy for what's happening specifically in the private sector. And it's heavily weighted towards small and medium-sized businesses.
Well, okay. The Main Street businesses?
The Main Street businesses, exactly. So when the official NFP is already low, 119K, and then ADP, which is literally capturing payroll processing data from hundreds of thousands of firms, dips into the negative, well, it suggests the hiring freeze isn't just in a few industries. It's becoming broadly distributed. It's a sign of decelerating momentum, almost like a canary in the coal mine for a deeper hiring contraction.
But here's the paradox, right? The thing that keeps everyone from shouting recession just yet is that weekly unemployment claims, they're still low. We aren't seeing massive spikes in people actually losing their job.
And that's the absolute core of this stagnation phase. It's the no hire, no fire consensus. Businesses aren't panicking and, dumping their entire workforce.
Why not?
Well, because finding good, specialized staff is still challenging in some areas, and they're terrified of the cost of having to rehire everyone later on. So instead of slamming on the brakes, which is a layoff scenario, they've just taken their foot off the gas.
So they're halting expansion?
Completely.
Yeah.
Crafting aggressive expansion plans.
Yeah.
They're choosing not to backfill roles when someone retires or quits. They are just waiting. They're waiting to see how the next year shakes out with interest rates, with tariffs, geopolitical stability, before they commit to any new headcount.
So it's the difference between like a sudden car crash and just running out of gas and slowly, painfully idling on the side of the road. Companies are conserving cash and their labor capital.
That's it.
And for you as an investor, understanding this no hire, no fire strategy is just vital. It means corporate earnings aren't necessarily falling off a cliff because companies are managing their second biggest cost, which is labor.
Right, they're controlling costs.
But at the same time, it means there's no engine for strong, broad economic expansion going forward.
Precisely. The analogy is spot on. We are no longer driving at highway speed, that aggressive hiring boom of the post-pandemic recovery, but we're not parked either. We're just cruising at this very slow, very cautious speed. And this stagnation, it allows large companies to manage their margins, but it creates this profound stress on the actual workers, which brings us to the next structural point.
This is where it gets really interesting for me. It's where the hard numbers diverge from the psychological reality. If the economic data suggests a mild slowdown, the worker psychology, according to the sources we've seen, suggests a psychological recession.
Yes.
We're talking about anxiety levels that are in some ways worse than the sharp shock of 2020. That is a truly staggering claim. I mean, think about the devastation of that initial COVID crisis.
It is staggering, and it speaks to the difference between, a sudden crisis and this long-term structural uncertainty. In 2020, the shock was quick, it was massive, and we knew the cause. It was a pandemic.
Right. There was a clear enemy.
A clear enemy. Now, the fear is pervasive, it's structural, and it's ambiguous. It's driven by AI, by layoffs at these supposedly stable big tech firms, and by a sense that the jobs that are being created are just harder to get.
So let's try and quantify that fear. The LinkedIn Workforce Confidence Survey data is, it's just brutal. In March of 2025, the Job Seekers Confidence Index hit an all-time low. It registered only a +5 on their scale, which runs from a -100 to +100.
It's basically flat.
Barely moved by summer, just sitting there at +6.
A +5 confidence score is, for all intents and purposes, zero confidence. It means that the slightest bit of bad news, a mild hiring report, a tariff scare, a bank failure, it will push that number into negative territory so easily. It suggests that individuals are just deeply pessimistic about their ability to secure a new role that matches their current salary or, their status.
So the feeling is just, I can't afford to lose this job.
I absolutely cannot afford to lose my job because the market out there feels rigged against me.
And the fear isn't just about finding a new job. In January 2025, confidence in keeping your current job, which is usually the hardest metric to move, that dropped to a 5-year low.
Yeah, that's a big one.
So people aren't just scared about the future, they're actively insecure about their present employment.
And this deep insecurity, it translates directly to things we can actually see, behavioral indicators. We're seeing a significant increase in the percentage of people adding that open to work badge to their professional profiles. This isn't passive looking, this is aggressive job hunting.
They're signaling, I'm available.
And what's particularly alarming, as the analysis pointed out, is that the confidence of these aggressive job seekers is lower right now than it was during the peak of the 2020 pandemic lockdowns.
That's incredible.
They are applying for jobs feeling like they have almost no chance of success.
And the data supports their pessimism, right? We mentioned the stagnation, but the actual numbers for hiring volume are pretty grim. U.S. hiring year-to-date in 2025 fell about 4% year over year.
And crucially, it remains over 20% lower than pre-pandemic 2019 levels.
Wow.
Think about that for a second. Even 5 years after that initial shock, the total hiring volume hasn't recovered to a baseline level. This is the definition of a widespread, selective hiring freeze. Large companies are using fewer resources to find new staff. They're relying on internal shuffling or, just increasing the workload of their existing staff.
Which only fuels that anxiety even more.
Of course it does.
I think the most culturally resonant metric, the one that tells the clearest story about this reversal of worker power, is the definitive end of the Great Resignation.
Oh, yeah.
I mean, we spent years talking about YOLO economics, right? People quitting en masse for better pay, better work-life balance. That seems to have just evaporated.
It's gone.
Yeah.
It did. That YOLO confidence has been completely replaced by better stick with what you have.
Right. Don't rock the boat.
Don't rock the boat. The voluntary retirement rate, or what they call the quits rate, has settled at 2.0% throughout 2025. That is the lowest level we have seen since the initial wave of the pandemic. People are being extremely cautious. They are not walking away from a job without a guaranteed, signed offer in hand.
And probably for a significant raise, too.
Oh, absolutely, a significant raise.
Yeah.
And this stabilization, while it might be good for business predictability, it severely limits wage growth and labor mobility. It just locks a lot of people into less than ideal jobs simply out of fear.
So what we're seeing really is that this widespread psychological fear, this weak momentum in income and job security, this is the single most crucial medium-term signal for consumer spending.
It has to be.
If the average American feels this insecure, they're going to delay major purchases, they're going to build up whatever modest savings they can, and they're going to prioritize paying down debt. And this consumer restraint, it has massive downstream consequences for global investors.
Absolutely. The consumer fear is the engine that stalls the global economy. If the U.S. consumer stops spending on non-essentials, let's say they delay buying a car, or they cut back on restaurants, or hold off on that expensive vacation,
Right.
it affects everything from German auto manufacturers to European luxury goods producers to Asian IT hardware companies. It's why we have to view this domestic labor data as a leading global indicator.
Okay, so since the overall market is stagnating, let's dig into where the jobs are being created and, more importantly, what kind of jobs they are. This sectoral momentum map we looked at, it really separates the strong pillars from the struggling sectors. Let's start with the high momentum areas.
Right. These are the sectors that are fundamentally what we call non-cyclical, meaning their demand drivers are structural, and they persist regardless of what the Fed does with rates or, even mild recessions.
Okay, so what's at the top of the list?
Top of the list is healthcare and social assistance. This is the most stable sector, driven entirely by demographics. You have the aging population, the sheer volume of baby boomers moving into retirement age, and that's combined with these persistent staff shortages in long-term care, hospitals, clinics.
And it's work that's very hard to automate.
Incredibly difficult to automate. That secures its position as a high-volume job creator. It's demanding work, but it's steady.
And closely related, you have education also holding up, especially in those critical areas like K-12, public schools, special ed, and STEM teaching.
Yeah, this reflects these persistent, often systemic shortages, especially in lower income and rural districts. These are essential services that, society simply cannot cut, even when things get tough.
Okay, so then we get to finance, which you said is a little more nuanced. It's not just, banks hiring tellers.
No, not at all. It's not broad-based hiring across commercial banks. Instead, the steady demand is for these very high-value, very specific roles. Things like risk management, which is driven by increasing regulatory complexity, regulatory compliance, data analytics, and critically asset management and advisory services. The same aging population that needs healthcare also needs wealth advisors who can manage their complex retirement accounts, estates, and trusts. This is high-margin, specialized financial, cognitive labor.
And finally, the most complex story of them all, tech. We hear about massive layoffs all the time, yet the data shows the sector is still creating 6,000 to 7,000 new jobs every month in 2025. So this isn't a traditional hiring surge, it's a radical restructuring.
It is a profound structural shift. The sources show demand is up over 70% year over year for very specific roles: AI, machine learning, data scientists, and high-level DevOps engineers.
Okay, so what's slowing down then?
Meanwhile, the traditional software maintenance or general data engineering roles, they're slowing down significantly. The priority has just shifted from headcount to capability. Companies are not looking for someone to, maintain legacy code anymore.
So what are they looking for?
They are explicitly demanding full-stack talent that builds products directly.
Yeah.
Especially people who can integrate generative AI into customer-facing operations.
Okay, let's be specific here, because this is where the job market gets incredibly selective. What does full-stack talent that builds products directly actually mean in the context of a 70% demand surge?
It means the generalist software engineer is being deprioritized.
Right.
A company used to hire, 3 or 4 engineers, one for the front end, one for the back end database, one for maintenance.
Right, a whole team.
A whole team. Now they are seeking a single person who understands the entire vertical stack, can integrate sophisticated AI models using specialized platforms, and can deliver a minimum viable product to the market in, say, 3 months.
So these are the premium roles.
These are the premium
Yeah.
roles. These are the people making automation happen, not the ones being automated away.
Hmm.
If you don't have that high-level specialized AI and data skill set, you are finding the tech doors rapidly closing on you.
So the summary insight for these high momentum sectors is really clear. They are either non-cyclical necessities like healthcare and education, or they demand the highest level of specialized cognitive labor like AI and specialized finance. It's either the human touch or the absolute cutting edge.
Precisely. Now, let's sharply contrast that with the low momentum sectors, the
Yeah.
struggling areas facing stagnation, automation, or these cyclical headwinds. These are the victims of that no hire policy we talked about.
Manufacturing is just hemorrhaging jobs. We saw a loss of 78,000 jobs year over year by August 2025. This isn't just cyclical, it feels structural.
It is. The sector's getting hit by restructuring in the auto industry, slowdowns in semiconductor and electronics demand, and just relentless competition.
And then you look at construction, stagnant or even receding a bit. This is a direct casualty of high interest rates, right?
Absolutely. The market for new residential and commercial real estate is just severely constrained right now. The sector is only being partially propped up by those massive public infrastructure projects and the semiconductor plant construction that was spurred by government incentives.
So if that public money slows down,
If that public money were to slow down, construction employment would likely fall off a cliff.
and the big one for consumer spending, retail, accommodation, and leisure. The post-pandemic rebound is definitively over.
It's over, and we are seeing rapid staff reductions here. The Chicago Fed estimates a loss of about 12,000 jobs in leisure and hospitality just in November. This sector is under intense cost pressure. Automation is rapidly moving into retail.
Self-checkout lanes.
Think self-checkout lanes proliferating everywhere. In leisure, businesses are seeking efficiency gains because of high wage costs and really volatile demand. They're just running leaner operations, forcing more work onto fewer employees, which, again, just fuels that worker anxiety we discussed earlier.
So the insight is that the struggling sectors, manufacturing, construction, consumer services, they're the cyclical areas that are most vulnerable to high financing costs, reduced consumer spending, and critically, these automation pressures that target low-skill, high-volume tasks.
Exactly.
This brings us to a really crucial structural difference that helps explain why the headline job numbers look kind of okay, stagnation, while the reality for people feels so terrible. We have a true dual structure between small and large employers. Let's start with the small business anchor.
Small businesses are the pillars supporting the sheer quantity of jobs right now. The NFI, that's the National Federation of Independent Business, they report that 56% of small businesses were reporting hiring or attempting to hire in October of 2025.
So they're still trying.
They're still trying. Their net increase plan, that's the percentage planning to add jobs, it's still positive, hovering around 15%, though it is softening a bit.
This suggests that Main Street is still trying to grow, but maybe more organically or just out of necessity. They have this certain cautious resilience.
They do. We call it uneasy optimism. Their owners, they still feel better than they did during the worst downturns, but they are incredibly cautious about committing resources. They struggle to find applicants for service roles, but they're also hesitant to commit to new permanent headcount because of all the macro uncertainty.
Things like tariffs, rates.
Everything from complex tax regulations to global supply chains to what interest rates are going to do next year. They need the staff, but they fear the long-term cost and the commitment.
Okay, now contrast that cautious optimism and stable hiring volume with what the large companies are doing. The restructuring that dominates the news. Challenger data is stark. Over 1.17 million planned layoffs were announced by U.S. companies between January and November 2025.
Yeah.
That is the highest annual level we've seen since the peak of the 2020 pandemic restructuring.
The strategies of large corporations and small businesses are just diverging dramatically. Large corporations are not just hiring less, they are fundamentally restructuring. And their decisions are driven by these really explicit factors. Pressure from shareholders for higher margins.
Always.
Intense adoption of AI and automation tech to replace human labor, and massive corporate consolidation across tech, telco, finance, and retail.
So their strategy isn't based on a cyclical downturn. It's a strategic move to permanently reduce the labor component on their balance sheet.
Absolutely. They are employing a really sophisticated strategy, It's hiring freezes for the generalist roles, selective hiring only for that specialized AI and data talent we mentioned, internal relocation, outsourcing, and most importantly, reliant on automation to eliminate roles rather than just simple headcount expansion.
So when a big company announces layoffs,
When a large bank or a major retailer announces layoffs, it's usually followed by an announcement about a new internal AI integration team, a team designed to prevent them from ever needing those roles again.
this dual structure, it raises some profound macroeconomic questions. You have small businesses keeping the job volume steady, which provides a kind of soft landing for the overall employment numbers.
Yeah.
But large corporations are driving this quality shift and accelerating structural automation.
And this just accelerates the bifurcation of the labor force. The market for high-value cognitive labor,
Yeah.
the AI specialists, the senior advisors, it's red hot.
Yeah.
It's driving up wages for the top 10% of the workforce.
And for everyone else.
Simultaneously, the middle and lower ends of the labor market are experiencing this painful friction. Stagnant wages, increased anxiety, and fewer opportunities for upward mobility as large employers automate away all the entry-level and routine jobs. This structural divergence in income potential is a key driver of long-term economic instability.
Which is precisely why global financial players are looking for macro hedges.
It all comes back to that anxiety.
Mm.
If the U.S. consumer, who's primarily working for a small business or facing automation at a large one, feels this insecure about their income stream, how can global investors rely on consumption-driven corporate profits?
They can't.
That anxiety on Main Street is directly linked to the need for hedges in the global market. And right now, the biggest hedge in the world is physical gold.
That's the perfect segue. When trust in the primary engine of global consumption, the U.S. consumer falters, and trust in the reserve currency that enables that consumption, the U.S. dollar is questioned.
The world reverts to the oldest form of trust there is, gold.
Okay, let's unpack this. This is part 2. For the last few years, it feels like the entire market conversation has been focused on the dazzling performance of growth stocks and AI, the cutting edge. Yet, quietly, gold, the oldest asset in the world, has delivered returns that make it one of the top-performing asset classes globally. It's hard to overstate the magnitude of this move.
It truly is historic, and it signals, I think, a fundamental concern about the future stability of the global financial system. According to the analysis we saw, on October 20th, 2025, spot gold hit an all-time high of $4,381 per troy ounce.
$4,381.
Now, that specific peak was short-lived, but the implications were huge.
And the year-to-date return by late November, we're looking at something like plus 50% to plus 60.6%, a 60% gain in a single year for an asset that's typically seen as this low volatility store of value is. It's staggering.
It is, and the World Bank analysis notes that this is the strongest annual gain since the late 1970s.
Which was a period defined by runaway inflation and global monetary upheaval.
The fact that gold is moving like a high beta momentum stock tells you that the drivers are not just minor rate adjustments. These are deeply structural global fears. And this movement is backed by massive physical demand. The World Gold Council's Q3 2025 report confirmed total gold demand, including over-the-counter trades, hit a record high of 9,313 tons for the quarter.
Okay, let's define over-the-counter, or OTC, demand, because that's important. OTC trades mean what? Large institutional purchases?
Exactly. Often directly between major financial institutions or sovereign entities rather than just market trades on an exchange or, someone buying jewelry.
So it's the big players.
It's the big players, and it signals profound conviction. This demand figure, it translates to about $146 billion in value, up 44% year over year. And when we look at the pattern, the price had that short-term correction after hitting $4,381, but it quickly resumed its upward trend. It just confirms that the underlying demand is rock solid.
So that correction was just tactical profit-taking.
That's all it was. The strategic players, they remain firmly in the market.
So if the structural demand is this strong, where is it all coming from? It can't just be individual investors buying gold coins.
It is not. And here is where the story gets really interesting. The main driver behind this structural demand isn't retail fear or even immediate inflation. It is official sector demand. Global central banks are the engine of this new gold supercycle.
The idea that central banks, the very institutions that issue fiat currency, are aggressively buying the ultimate anti-fiat asset, that's a deep contradiction that just speaks volumes about global trust. How significant is their buying volume?
It is structurally massive. Central bank buying has been at historical highs since 2022, and it just accelerated again in 2025. In Q3 of 2025, Central bank net purchases were 220 tons. That's a 28% increase quarter over quarter.
So even though the pace has slowed a little from the absolute peaks of 22 and 24, the volume is still way above the average from the 2010s.
Far, far above the average. It marks a complete structural shift in the gold market. Analysis from the European Central Bank shows that central banks now account for 20 and 25% of total annual gold demand.
And what was it, a decade ago?
A decade ago, they accounted for only about 10%. They had doubled their market share. They now act as the structural price floor for the metal.
And the buying accelerated even more recently. October 2025 saw the largest monthly net purchase of 53 tons, up 36% month over month. Which nations are leading this charge?
Well, the sources highlight nations that are deeply involved on global political and economic friction. Countries seeking reserve diversification. Poland is a major buyer, with 83 tons year to date. You also have significant purchases from Kazakhstan, Brazil, and several Middle Eastern nations. This tells us the buying is a global phenomenon.
It's not just one country.
No, it's driven by sovereign entities that recognize the fragility of the current geopolitical climate.
This brings us to the crucial why, this de-dollarization theme. Why are emerging market central banks suddenly piling into gold, especially when the US dollar is still the dominant global currency?
It stems directly from geopolitical risk, and it was catalyzed by the use of financial sanctions. Following the sanctions placed on Russia, specifically freezing their foreign reserves held in USD and EUR emerging market central banks, learned a very painful lesson.
Which was?
That holding your reserves in fiat currency, even the dollar, exposes you to direct political seizure risk. Gold, because it's physical and is held outside the traditional U.S. banking system, is the ultimate hedge against this seizure risk.
So the analogy is simple.
Gold is the ultimate financial prepper asset for nations. They are fundamentally reducing the share of USD and EUR in their foreign reserves to protect their wealth from being, well, politically weaponized.
So it's not just a hedge against inflation anymore, it's a hedge against the U.S. government itself.
Exactly. It's a hedge against political risk and the potential breakdown of the fiat system itself. And that systemic risk perception, it's compounded by the other key piece of this puzzle, the shift in U.S. monetary policy, specifically the end of quantitative tightening, or QT.
Okay, quantitative tightening is one of those complex terms we need to break down. What is QT, and why does its end in December 2025 matter so much for gold?
So QT was the process where the Federal Reserve was actively shrinking its balance sheet. They were letting bonds mature without reinvesting the proceeds, which effectively removes liquidity or money from the financial system.
It was designed to pull back all that stimulus from the pandemic.
Exactly. So the fact that the Fed officially ended QT in December 2025, stabilizing its balance sheet at around $6.5 trillion, that is hugely significant.
Why that number? Why $6.5 trillion? Why not let it shrink even further?
That $6.5 trillion figure, it signals that the Fed is settling into a new regime of maintaining a massive permanent balance sheet. They're choosing to keep that safety net large. What's more, they're shifting their reinvestment strategy. They're moving maturing mortgage-backed securities into treasury bills.
And that guarantees...
What? It guarantees continued high liquidity in the system. And high liquidity, meaning a large supply of dollars just floating around, is fundamentally supportive of gold. Gold acts as a hedge against the debasement of currency when the money supply is kept artificially high, regardless of the immediate inflation levels.
So, to sum it up, central banks are buying gold because they distrust the political power of other nations, and they're buying gold because they recognize that the major reserve currency issuer, the Fed, intends to keep a huge amount of monetary stimulus permanently in the system.
It's a perfect confluence of geopolitical fear and monetary policy accommodation.
We've established that this surge isn't due to a single cause, but this powerful, almost toxic combination of geopolitical anxiety and accommodating monetary policy. What were the core factors driving that over 40% annual price rise, and what's the outlook for 2026?
The analysis attributes that massive gain primarily to four major intersecting factors. One, persistent geopolitical tension from U.S.-China dynamics and tariff uncertainty to the conflicts in the Middle East and Ukraine. Two, the relative weakness of the U.S. dollar through most of 2025.
Okay.
Three, the market pricing and future inflation risk combined with slow growth, that stagflation potential. And four, critically, that sustained record-breaking central bank purchasing.
After such a massive run, an investor might worry that, the rally has exhausted itself. What do the analysts suggest will keep the momentum going into 2026?
The consensus is that while gold is certainly not cheap at these levels, the structural framework remains powerfully bullish. The future upward momentum is supported by, again, four key factors. First, continued ample liquidity post-QT, which we just discussed.
Right.
Second, the rising possibility of stagflation, that painful combination of slow economic growth and persistent, sticky inflation risk. Third, the ongoing high level of geopolitical risks, which show no signs of going away. And fourth, that structural floor provided by sustained central bank buying.
Let's dig into that second factor for a second. Stagflation. Why does that specific economic condition, slow growth and high prices, make gold so attractive?
Stagflation is the ultimate nightmare scenario for traditional assets.
Yeah.
But gold loves it. Think about it. If growth is slow, corporate profits suffer, which hurts stocks. If inflation is high, bonds, which offer fixed returns, suffer because your real return is negative. Gold, conversely, it performs as a real asset that holds its purchasing power during inflation. And since it has no counterparty risk, it performs well when trust in the traditional fiat system wanes. It's the perfect shelter from that specific storm.
So the structural framework is really cemented. You have accelerated central bank buying, driven by distrust, combined with this potential reemergence of inflation and liquidity that provides strong long-term momentum. The 2025 data just confirms that strategic conviction at the highest levels of global finance.
It does. It's a complete re-entrenchment of risk management. When sovereign entities are this active, they are signaling a lack of complete faith in the stability of both the currency and the political apparatus that stands behind it. And that signal is far more powerful than any short-term futures trade.
Okay, so if you are an investor looking at these facts, the first question has to be, how should I fundamentally regard gold after a 40 to 60% run-up? Has it evolved from being a purely defensive hedge into something else?
It has definitely evolved. Gold is no longer a simple defensive hedge meant to, offset portfolio losses during a mild recession. It is now a full-fledged momentum asset.
A momentum asset.
Driven by powerful structural factors, specifically central bank strategic purchasing and long-term monetary policy, rather than just immediate fears about short-term rate hikes.
That's a crucial distinction. What risk awareness comes with treating it as a momentum asset?
You need sensitivity to short-term correction risks. Gold has a high opportunity cost, and it reacts strongly to two things: the U.S. dollar strength and, more importantly, real interest rates. If the dollar sharply rebounds, or if real interest rates dramatically increase, we could see a tactical sell-off.
Let's pause and define real interest rates, because that is the key determinant of gold's short-term attractiveness.
Right. Real interest rates are simply the nominal or the stated interest rate offered by something like a treasury bond minus the current rate of inflation. Gold is a non-yielding asset. It pays no interest. So when real interest rates are high, meaning the nominal rate is significantly higher than inflation, bonds offer a great real return. The opportunity cost of holding gold is high. Why hold a zero-yielding asset when you can get a 3 or 4% guaranteed return after inflation?
But when real rates are low...
Conversely, when real rates are low or negative, as they have been for much of this cycle, the opportunity cost of holding gold drops to near zero, which makes it very attractive. That relationship is paramount for short-term gold price movement.
That makes perfect sense. Now let's talk about the differing time horizons. You mentioned this provides a fantastic strategy insight.
It does. Central banks operate on a 10-year, 20-year, or even longer view. They are building permanent sovereign reserves to offset risks like sanctions or currency debasement. Private investors, the ones trading ETFs and futures, they operate tactically, usually on a 3 to 12-month timeline based on volatility and expected rate moves.
So the strategy insight here is to look for the dislocation between those two. If we see private investors panic and start selling off their gold ETFs because, say, the dollar strengthens for a few weeks,
Right.
but the central bank buying reports remain steady, showing Poland or Brazil are still acquiring tons of physical metal, that disparity signals a structural floor and a potential buying opportunity for long-term investors.
Exactly. You use the steady hand of the sovereign buyer as a guide to the metal's underlying structural value, and you filter out the short-term noise generated by the futures markets.
We also have to reevaluate correlations. Traditionally, gold was the anti-equity trade. It went up when stocks went down. But the 2025 rally was anomalous. Gold surged even as risk assets, especially AI and growth stocks, performed extremely well.
This forces a major change in perspective. Gold is no longer a simple anti-equity trade. The fact that both went up means that two different kinds of systemic risk are driving the market at the same time.
Are they?
You have the risk of missing out on technological growth, which drives stocks, And you have the risk of policy failure, monetary debasement, or geopolitical instability, which drives gold. Gold should now be viewed as a separate hedging pillar, distinct from market volatility. It's a hedge against currency risk and systemic policy failure, regardless of whether Apple or Microsoft are doing well.
That helps us set up our scenario planning, which is essential for any disciplined investor. What 3 scenarios should the listener be watching for when positioning themselves based on this gold data?
Okay, we'll look at the outcomes based on growth, inflation, and policy. Scenario A is the soft landing plus inflation reemergence. In this case, QT has ended, the Fed cuts rates slowly to support employment, and fiscal spending continues. So real interest rates stay low, and the dollar weakens mildly.
If that scenario unfolds, what's the outcome for gold?
Gold continues its volatile high trajectory. It'll likely trade within a high range, but be supported by the liquidity and the continued fear of inflation reemerging due to those slow rate cuts. This is more or less the path we're on right now.
Okay, scenario B. Great slowdown plus disinflation. What if that stagnation phase in the labor market turns into a serious downturn? U.S. and European growth drops significantly, causing inflation to fall quickly.
If inflation collapses, it causes real interest rates to rise quickly, even if nominal rates are dropping. Bonds suddenly become highly attractive again relative to gold. In that environment, gold would face a significant correction from its current high. The fundamental reason for the hedge, that loss of purchasing power, would be receding.
And finally, scenario C, the catastrophic policy failure or trust erosion. What if confidence in the monetary or fiscal system just completely collapses, maybe due to a debt crisis or a major geopolitical conflict?
If that happens, you would see a flight to the most trusted hard assets. Stocks and bonds would sell off simultaneously, meaning bonds lose their status as a safe haven, and gold would receive an extreme safe haven premium. This is the scenario that central banks are explicitly hedging against with their buying. It's the high-risk, high-reward scenario where liquidity suddenly vanishes and only physical assets matter.
The lesson there is clear. An investor's job isn't to predict, but to define the role of gold in each of those possible outcomes, A, B, or C, and then set up rules for your portfolio adjustment based on the incoming data, whether it's job confidence or central bank purchasing reports.
Definitely.
This has been an incredibly deep and insightful exploration. To synthesize the 2 major themes we covered today, the U.S. labor market anxiety, it confirms that growth is slowing but holding, driven by a profound structural shift. You have small businesses maintaining volume, while large corporations accelerate restructuring around AI and automation.
And gold's record run confirms a deep underlying nervousness in the global market about currency stability and geopolitical risk. And this anxiety persists regardless of the strong performance in the equity market, which means the global financial system is pricing in a systemic risk that hasn't fully manifested yet.
So if we connect the dots one final time between these 2 major forces, what is the crucial takeaway for the global investor?
It goes back to the U.S. consumer. The weakening income and spending momentum that's suggested by the worker anxiety data, that is the crucial medium-term signal for global demand. Since the U.S. consumer is the engine of nearly all global corporate profit, investors, whether you're in London, Tokyo, or Frankfurt, you must monitor U.S. labor metrics like job confidence and voluntary quit rates as a leading indicator for the performance of major international companies that rely heavily on American consumption.
So we're watching the pain on Main Street to forecast the global macro outcome.
That's it.
That really shifts the focus from purely local U.S. policy to a global risk assessment tied to consumer psychology. Now, we've established that large corporations are systematically using AI and automation to reduce headcount and dramatically improve their margins. This efficiency is necessary for profit, but it raises a massive structural question for the next decade.
Yes. The fundamental issue is one of wealth distribution and consumption capability. If productivity dramatically increases, meaning the economy can produce vastly more goods and services with far fewer people, but job creation stagnates. What does that fundamentally mean for consumption?
Who's going to buy all the stuff?
Exactly. Who is going to buy all the things the highly productive automated economy creates if the working class is struggling with job anxiety and stagnant bifurcated wages? We have solved the production problem, but we may have created a massive consumption paradox.
That is the structural challenge that will define the next economic era. A truly provocative thought to end on. Thank you for walking us through this deep dive.
My pleasure.
Don't forget to subscribe and hit that like button.